The primary reason traders lose money is their inability to properly identify market structure. They focus on indicators, patterns, and complex strategies while ignoring the fundamental framework that drives price movement. Market structure determines everything. Without understanding it, you're essentially trading random price fluctuations rather than structured market behavior. This leads to poor entry timing, incorrect position sizing, and ultimately, consistent losses. Most traders can't distinguish between trending and ranging markets. They apply trending strategies in consolidation phases and range-bound techniques during strong directional moves. This creates a cascade of problems. Stop losses get hit during normal retracements, profits are left on the table during trend continuations, and reversal signals are misinterpreted as continuation patterns. Understanding market structure isn't optional. It's the foundation that determines whether your trading approach has any statistical edge. Every market operates in one of three distinct phases. 1. Uptrend. Price creates higher highs and higher lows. 2. Downtrend. Price creates lower lows and lower highs. 3. Consolidation. Price moves sideways within defined boundaries. These phases don't occur randomly. Markets transition between trending and consolidation in cyclical patterns. Consolidation phases serve a specific purpose. They allow institutional players to accumulate or distribute positions without causing significant price disruption. Trends don't continue indefinitely. They require consolidation periods to build momentum for the next directional move. Recognizing when a trend is pausing versus when it's reversing determines your trading success. The institutional money that drives major market moves operates on this structural framework. They accumulate during consolidation, push price during trends, and distribute near turning points. Before analyzing any setup, first determine the current market phase. This single assessment will filter out 70% of low-probability trades and align you with the dominant market forces. Academic examples show clean, stair-step patterns that rarely appear in live markets. Real structure includes false breakouts, liquidity grabs, and internal complexity that can obscure the overall direction. The key distinction lies between external and internal structure. External structure, major highs and lows that define the primary trend direction. These levels represent significant institutional positioning and create the framework for major price movements. Internal structure, minor fluctuations that occur between major levels. This includes pullbacks, consolidations, and minor breakouts that don't affect the overall trend. Most trading failures occur when traders mistake internal movements for external signals. They see a minor retracement and assume the entire trend has reversed. Or they interpret internal breakouts as major directional changes. The practical application. Focus on the significant levels that are visible across multiple time frames. If you need to zoom in to see a level clearly, it's likely internal structure and shouldn't drive major trading decisions. Institutional players operate on external structure, while retail traders often get trapped by internal movements.
It's a trap! It's a trap! It's a trap!
Accurate identification of major structural levels requires specific criteria, not subjective interpretation. Major high definition, the highest price point reached before a significant retracement begins. This represents where selling pressure overcame buying pressure sufficiently to reverse the immediate trend. Major low definition, the lowest price point of the impulse wave that preceded the break of the previous major high. This level represents where buying pressure was sufficient to initiate the upward movement. Identification process. 1. Locate the most recent significant directional movement. 2. Mark the starting point of that movement, major low. 3. Mark the termination point before retracement, major high. 4. Everything between these points constitutes internal structure. Validation test. Major levels should be clearly visible when you zoom out to higher time frames. If a level disappears or becomes insignificant on larger time frames, it's internal structure. In an uptrend, when price breaks above a major high with conviction, this creates a break of structure, BOS, indicating trend continuation. When price breaks below a major low, this signals potential trend reversal. Break of structure. Signals provide high probability continuation entries, but only when specific conditions are met. 1. Price must penetrate the major high level. 2. The candle body must close above the high, not just the wick. 3. The break maintains validity even if price immediately retraces. Invalid break scenarios. Long upper wick penetrates the level, but body closes below. Exception. If the subsequent candle's wick exceeds the initial penetration, the break becomes valid. This distinction matters because institutional orders are executed at body levels, not wick extremes. Wicks often represent liquidity grabs or stop-loss hunting rather than genuine directional intent. Bearish boss operates with identical logic. Price must break below the major low with the candle body, not merely touch it with a lower wick. Professional traders wait for body confirmation because it represents where real money is positioned, not where temporary liquidity was grabbed. These rules filter out the majority of false signals that trap inexperienced traders. Change of character, CHOCH, indicates when the prevailing trend structure has been compromised and reversal becomes probable. It occurs when, in uptrends, price breaks below the most recent major low. In downtrends, price breaks above the most recent major high. Minor versus major change of character. Minor, when price breaks internal structural levels during normal retracement phases. This is standard market behavior and does not indicate trend reversal. Major, when price violates the external structural boundaries that define the current trend. This suggests institutional positioning has shifted. Common trading error, reacting to minor change of character as if it were major trend reversal. Traders see internal level breaks and immediately reverse their bias, only to get stopped out when the primary trend resumes. Professional approach. Only consider trend reversal when price convincingly breaks major external levels. Internal breaks are opportunities to add to existing positions, not reverse them. Like break of structure, change of character must be confirmed with candle body closes beyond the structural level, not just wick penetration. Master structural identification first. Every other aspect of trading, timing, risk management, position sizing, depends on accurate structure reading. Without this foundation, even profitable strategies will fail when market conditions change. Understanding market structure separates consistent traders from those who rely on luck and favorable conditions. Have you heard of the silver bullet trading strategy? In this video, we backtest it with real data to see if it delivers on its promises.